We're glad to have you back. This is Business Nigeria with Tolulope Ogunjobi. Now to our next discussion. In response to the evolving financial landscape and to align with international best practices, the Nigerian Deposit Insurance Corporation has reviewed upward the maximum deposit insurance coverage levels for all licensed financial institutions, while the NDIC raised deposit insurance coverage for deposit money banks from 500,000 naira to 5 million naira. It raised coverage for the Microfinance Banks from 200,000 naira to 2 million naira. It also raised the coverage for primary mortgage banks from 500,000 naira to 2 million naira. The same applies to payment service banks from 500,000 naira to 2 million naira, while maximum insurance coverage of subscribers of mobile money operators was reviewed upward from 500,000 naira to 5 million naira accordingly. What does this mean for the entire sector? Let's get talking. I'm being joined by Professor of Finance and Capital Market, the President of the Association of Capital Market Academics of Nigeria, Professor UcheUwaleke. He joins me live from our Abuja studios. Prof, thank you for your time. Good afternoon.
Thanks so much, Tolu. Always my pleasure.
Now, what is the maximum deposit insurance coverage and its significance in the deposit insurance system?
Yeah, Tolu, let me even start by commending the NDIC for coming up with the new deposit coverage level. First and foremost, deposit insurance is simply a system that is created by the government to protect depositors against loss of their deposits in the event of the failure of any of the insured institutions. And you now tend to ask, what's the primary motive? Because essentially, of course, it's not the same as conventional insurance that involves the policyholder and the insurance company. This is a tripartite arrangement involving the deposit insurer, the institutions themselves, and the depositor. So the primary aim is to ensure that depositors can go to bed with their two eyes closed and have a sound sleep. Depositors can be assured of the safety of their deposits, in the banks. And what does that do? Of course, it engenders a public trust. It engenders a confidence in the banking system, and then ultimately it leads to banking system stability and financial system stability, in general. So it's something that is very critical. And in Nigeria, the agency or the institution that is responsible for administering the deposit insurance scheme, happens to be the NDIC. And the NDIC has four core mandates: the mandate of deposit guarantee, the mandate of bank supervision, distress resolution, as well as bank liquidation. But of all these four, the one that is very critical is the deposit guarantee that ensures that depositors or guarantees them a payment of deposits up to a certain limit in the event of the failure of any of the insured institutions. And of course, these insured institutions deposits include deposit money banks, include the microfinance banks, include primary mortgage banks, include even non-interest banks, the payment service banks, and of course the money market operators, that are covered through what is described as the pass-through, because it's actually the pool of funds, that is with the banks, of course, covered. So, and we also know that it's not all deposits that are covered by the deposit insurance scheme. The NDIC Act 2006 and the current one, 2023, makes it clear, gives exemptions that it doesn't include interbank takings, it doesn't include deposits by, insiders like staff, and of course it doesn't include deposits that are used as collateral for loans. But essentially, it's something that is, designed to ensure financial system stability, improve confidence in the banking, in the banks, and I see this as one of such. Because today, as you know, Tolu, the central bank is worried about well, if you can call it seeming loss of confidence. People now keeping so much cash outside the banks and not wanting to drop the money with the banks. So this is one move that will help to, boost confidence and also increase financial inclusion. So for me, it's a welcome development.
You hit my next question because I was saying the rationale behind the upward review of maximum deposit for coverage by the NDIC. But what impact will this have on the banking system and the economy, in your understanding?
Oh, of course, very positive. It's going to be very positive, especially against the backdrop of what the central bank is pursuing now. Banking sector recapitalization, trying to encourage banks to increase their, paid-up share capital. So it's going to, help. As I said earlier on, it also increase the deposit level in the banks, because once confidence is, being engendered, once you have the trust, public trust, being improved upon, of course, you should expect that people will now want to, put their money in the bank. So again, that speaks to financial, financial inclusion. Again, we also remember, Tolu, that this deposit coverage level doesn't just come like that. The NDIC conducts research from time to time to ascertain what you might describe as the adequacy of the coverage level. So from time to time, it's expected that NDIC evaluates the effectiveness of the deposit insurance scheme, and that is what they have done, and that is what is leading to what we'll have today. Now, if you go back to history, the NDIC actually started operations in 1989, and at the time, the coverage level was just 50,000 naira, okay? And in 2006, if I recall, it was increased to 200,000, for deposit money banks. And it was also in 2006 that for Microfinance Banks, I think that was introduced, 100,000 naira. Now, another increase was done in 2011. In 2011, for deposit money banks, the coverage level was increased from the 200,000 to 500,000. And since 2011, this deposit coverage has not changed, okay, until the recent pronouncement. So you can see over the time it has not changed. And this is despite the fact that inflation rate has been on the rise, despite the fact that exchange rate too has been on the rise. Okay, a lot of events have happened in the financial sector. So it is something that was long overdue. Let me put it that way. And of course, the NDIC usually takes into cognizance a number of factors before coming up with any figure as to represent the coverage level. And some of these factors include the trend in exchange rates, inflation rates, including even the distribution of the deposits that we have in the bank. So all of these have combined to bring about what we have today. And of course, just as you mentioned in your introductory statements, is also in line with international standards. The Principle 8 of the International Association of Deposit Insurance, requires deposit insurance institutions to from time to time evaluate the adequacy of deposit insurance, with a view to again bringing about changes in the deposit coverage level. Now, let me also say this, that you see, it's important when you are reviewing your deposit insurance system to ensure that a majority of depositors are covered. Okay, and what we have seen over time is that has been the case. Over 85%, okay, of depositors are usually covered, 100% covered at any point in time. But again, over the time, we've also seen a situation in which a large, proportion of deposits, remain uncovered, which is also why this new, if you like, new regime of deposit insurance coverage is very very important, because what the NDIC has done is that if you look at it, for deposit money banks, about 98.9%, coverage, has been targeted, and in terms of value, I think about 25% of in terms of value. So that tells you that the virtually 100% of depositors, are covered by this new regime. So for me, it looks adequate, and again, it must remain limited. Of course, not everything will be covered. Not all the deposits will be covered. Again, because you don't want to incentivize banks to take unnecessary risks. You want to at least encourage them to continue to maintain market discipline, so they don't say because everything is covered they begin to give out loans anyhow. So I think overall what the NDIC has done will go a long way to help strengthen our banking system and also strengthen our financial system. So depositors can now relax. If you have, for example, if you have 5 million naira in a bank and the bank is, collapsing, or bank is declared, insolvent, you stand to get back your full amount, the 5 million naira. Of course, when as a depositor, if you have it in different branches, if you have money in different branches, all of what you have in different branches will be consolidated, will be seen as one single deposit. So the best bet, my advice to depositors would be, if you have 10 million, for example, and you put all the 10 million in a bank and a bank collapses, what you get is you get your 5 million naira, NDIC gives you 5 million naira, then the balance of what you have there is something you get by way of liquidation dividend. So if in the course of realizing the assets of the bank, there is still money left, of course, you'll be paid. But if that 10 million naira is, split into two banks, for example, you have Bank A and Bank B, and you put 5 million naira in Bank A, and you put 5 million naira in Bank B, these two represent two different insured institutions. And what that means is that as a depositor in these two banks, you stand to get back your full 10 million. Because from the first bank, you're getting 5 million. From the other bank, you're also getting 5 million. So what it means is that depositors will be encouraged to now, if you like, call it diversification. So as opposed to having all your money in one bank, it will be advisable to also have it in several banks, such that when such happens, in the unlikely event of failure, you stand the chance of getting virtually all that you have put in the bank.
It's a lot, Prof, because I want to say this upward review, would it pass additional burdens on the banks in terms of premium payable to NDIC?
Yeah, so that's a very good question. And on the sidelines, I've been asked this question in terms of premium. Of course, when you talk about insurance, deposit insurance funds, the bulk of it in many jurisdictions, come from premium paid by insured, institutions. And this premium, let me emphasize, is based on deposits, total deposits, excluding the ones, specified in the Act, which I mentioned, interbank, placements, the ones by insiders, and then the ones used as collateral for loans. So if you exclude those ones, okay, those ones that qualify as deposits will be ones to attract premium. So premium is based on deposit, total deposits. And again, part of why we may not see any, if you like, burden on the part of banks is on account of the new system that the NDIC adopts, in the application of premium. What is that system? Before now, NDIC used to apply a flat rate, a flat rate premium. And, over time, NDIC, transited from a flat rate premium to a differential, assessment, the system, differential payment assessment, system, by which what is NDIC does now is to classify banks, insured institutions, into buckets. Okay, this is more like a risk-based approach. you classify banks into buckets, several buckets, and you apply premium based on the risk level of a particular bank. So you now find the NDIC using some quantitative and qualitative criteria to determine payments by the banks. For the quantitative criteria, for example, you find the NDIC using the prudential ratios, largely the asset quality, non-performing loans, for example. The central bank says the threshold is 5%. Okay, so if it is 5%, maximum 5%, and Bank A, for example, is doing 4%, and Bank B is doing 2%. Of course, Bank B will be considered less risky than Bank A, and Bank A will be required to pay more premium than Bank B. So it's in line with risk. There is also the liquidity ratio component there. We know liquidity ratio threshold is 30%. So the higher your ratio, the less risky you are. And there's also the capital adequacy ratio. So these are the quantitative techniques used by NDIC to compute the premium. So at the end of the day, you now discover that by the time they add these points to the basic rate, what you now pay as a bank by way of premium will now be a function of the risk levels. All right. So I think the entire add-on is just about 0.3 or 30 basis points on the basic premium. So in terms of premium, again, it's a function of deposits. They hire the deposits of a bank, and I expect that with what has happened now, with banking recapitalization, with efforts being made to boost confidence in the banking sector, deposits are likely to improve. And if deposits increase, you should also expect that the premium paid by the banks will increase. But what is more important is the point I stressed earlier. That's not just about a flat rate premium system, but it's more about the the risk-based approach being taken by the NDIC now, which has proven to be a lot more effective. So it's not going to be any it's not going to have any negative impact on the banks, coming from that perspective.
Now, almost finally, does the NDIC have the capacity to pay depositors the new coverage limits in event of bank failures? That's on one side. And what about if the balance is above 5 billion in short sums if the bank fails?
Yeah. So let me start with your second question. I have even touched on that, before now. And I had said, for example, if you have the deposit in excess of 5 million.
Okay.
Now, imagine if we were still in the old regime when the highest was 500,000. 500,000. Imagine just getting 500,000, against the backdrop of rising inflation and all that. So it was good the NDIC even increased it to 5, times 10, 5 million. So if as a depositor you have in excess of 5 million, what of course the maximum limit coverage is 5 million. So 5 million is what you stand to get. That's why I talked about I gave an advice. I said it would be better for a depositor to put money in 2 banks, for example, or 3 banks, to be sure that the first bank gives you 5 million, the second bank also gives you 5 million, and the third bank gives you 5 million. But if you put all the money in one bank, the maximum you can get from that one bank is just 5 million. Okay, so you can see the wisdom in spreading your money in different banks, because in the unlikely event of failure, you can only get a maximum of 5 million. Okay, but if if you put your money in several branches of a bank, it's still considered as one deposit. Okay, now to your question as to whether this NDIC has capacity, I think the NDIC is adequately funded to be able to meet any such commitments. And that's also why the NDIC does not use the fund, the premium paid by banks, to meet overheads or meet administrative expenses. Okay, any cost the NDIC incurs in this operation is not usually spent from the fund. Okay, so what NDIC does with the funds is that NDIC invests these funds in usually government securities that are very liquid. Okay, that can easily be realized. It is the income from such investments that the NDIC uses to meet its running expenses administrative overheads, and so on. So NDIC does not actually touch the fund. So the fund is always there. NDIC has the ability and capacity to meet any such commitment. And again, that's also why, as I said, it's completely different from the conventional insurance. NDIC is always there to ensure that in the event of any failure, the depositors don't lose. Depositors at least get something substantial from what they have deposited. So for me, what the NDIC has done is a welcome development, and I think it will go a long way to strengthen the financial system and also boost confidence of depositors in our banking sector.
Well, indeed, this sounds pretty good. I must thank you so much. That's our time. I've been speaking to Professor UcheUwaleke there, breaking this down, the benefits of all of this moves by the NDIC to boost confidence and, of course, safeguard our depositors. Professor Uwaleke is a professor of finance, capital market. He's also the president of the Association of Capital Market Academics of Nigeria. Prof, thank you for your time.
My pleasure, Tolu. Thank you.